Good evening, everybody.
Welcome to the Live at 5. This is our Ask Us Anything about real estate. So make it real estate related. Before we get started, I want everybody to know that you just go ahead and drop your question in the chat, and then we're going to have a live Q&A at the end. We'll answer any questions that you have. Ready? So we're ready to rock?
Ready to rock?
Cool. Go ahead.
So we always start the Live at 5 by talking about some of the updates of our students who are in our mastermind and what they're up to, because I know a lot of you like to follow their journeys and see what they're up to, knowing what's ahead for you. So Lupe is closing on her 5th unit. It was supposed to be on Friday. She even had the mobile notary come over and they signed all the documents, and then there was some kind of delays with title, so she's just waiting, but she's done everything that she needs to do to close her deal, and but she should have 5 units by this week.
I think we just had a costume malfunction. Did your earring fly out?
Oh, my earring did fly out.
I better get that.
Well, that's unfortunate. All right. Steve Caro, he's still doing his due diligence on his 16 unit with seller financing in Miami. That's still going on. Misty closed her first deal, so she's now working on her rehab. I think the rehab is going to start this week, so yay, Misty. And now she's going to get the experience of going through working with a hard money lender and learning about, it's one thing to learn something in theory, it's something else to learn it like when you're actually doing it in practice and dealing with the draw requests and what kind of paperwork do they need and following up with the contractor and all that. So we're excited for her journey because it's just the first of many, and the first one's always the most impactful because you just learn so much. So great job, Misty. Suzanne just joined the mastermind last week, and she was actually already in contract on a deal. So we immediately jumped on a strategy call and started talking about her deal and gave her several things to do for due diligence, like very, very quickly. And she ended up making the decision to back out of the deal. Yesterday, when I did a live, I was talking about matching up your strategy with due diligence, and that was one of the deals I was talking about. So the reason I put it as far as like a client win or journey update is when you get into your first property and you're doing due diligence, it's hard to make the decision sometimes to back out because it takes so much work to get your business up and running and just get there to begin with. So Suzanne, I just want to say congratulations for getting through your first like rental type due diligence. Now when the next one comes, you're going to be so much more prepared and ready, and now you've been through it, you know what to expect, and now you have us holding your hand along the way to help you with you being in the mastermind. So we have Natasha, who is selling a property that she did a beautiful renovation on, and she's just dealing with the buyer. Buyer's coming back and trying to negotiate, so she's just working through the details of that. And so Natasha, we are just rooting for you. Keep going. Let's get that thing closed. And Dustin, he is new in our mastermind, just joined last month. And he just messaged in a little while ago that he made his first 2 offers today. So, woo! Good job, Dustin. We're excited for you.
Nice.
Those are all the ones I can remember. And Debbie and Felicia got a commercial property under contract today in North Carolina. Yeah. And they live in Colorado. So, yet another remote deal for one of our students.
So awesome. We also had some action takers that joined our mastermind last week. So we're really excited. We had Regina Lucero join us. We had Joseph Gibbs join us, and then we had 2 upgrades. So Griffin and Crystal Brooks, well, Griffin Brads and Crystal Brooks, we want to say congratulations. I know that you guys upgraded to Platinum Coaching, and we're super excited that you guys are going to have a one-on-one coach holding your hand through all of the fun chaos. So congratulations. Let's see, I don't see any questions coming in yet, and we're about ready to talk about a topic of the week. So if you have a question, like put it in the comments right now.
Yep. Any questions you have, let's hear them. Go ahead and type them in.
In the meantime, the topic of the week is contesting an appraisal. Ooh, that's good shit.
Yeah. So Regina, who is new in our program, already has her first rental property under her belt. She bought it, she renovated it, and now that she's refinancing it, the appraisal is coming in significantly lower than what she had originally planned, and so that's impacting her refinance. So I was just coaching her through. She's in our mastermind, so she has the course. And in our course, I went through big details on how to contest an appraisal. We've done it multiple times successfully, and apparently it's very difficult to get an appraisal overturned. And we've done it 6 times?
Because she's really good at it.
Because there's a strategy, and I don't think I've ever heard anyone talk about it, but because I had an audit background, I basically went in and audited the appraisal that was done by the lender's appraiser. And so what I wanted to talk to you about today is how to think through the challenge of, well, what happens if your appraisal does come in low? Especially if you already own it and you like legit needed to appraise to refinance. You know, there's sometimes where an appraisal will come in low when you're buying something, and that's disappointing because you're like, oh man, the deal's not going to work. Sometimes that's a blessing in disguise because maybe it wouldn't have appraised at the end of it when you really needed it to. But let's say you're already in the deal and you have a property that's not appraising for what you needed to appraise for. And you'd already done all the research ahead of time. So like, you know what it should appraise for. So what I want to do is teach you how to think through that challenge and how you would piece together the different pieces to make the best argument you absolutely can for getting that appraisal overturned and getting a higher appraised value. We did this back in, it's been almost 2 years ago, in January of 2019. We were doing a portfolio refinance just for 10 of our units. And it was 6 properties, 10 units. And our bank came back, every one of the appraisals came back way lower. And trust me, when we go buy a property, we know how much they're worth when we go to refinance them because that's how we base our offer price. So I was very confident in what it should appraise for. So when they came back, I was like, oh, I don't think so. Absolutely not. So what we did is we took the appraisal and literally what I had to do is I had to make 2 different arguments. So if you think about it, I had to show that the appraiser was incorrect. But of course, there's a little bit of politics you have to play there because you don't want to tick the appraiser off, right? So what you have to do is create the argument that the comps that the appraiser used are not actually comparable to your property and why. And then you additionally have to show them which comps should be used and why. So this is not a short time frame. I think I spent 3 to 4 hours on each property to do this, maybe even longer. Like it takes a lot of time. But I mean, our refinance was at stake. So you're going to do what you got to do. So when you first start off by picking apart the appraisal, you're literally going to pull the appraisal. They always have to use specific properties as comps. So first thing it is, I pulled the first property and I looked at it and I was like, okay, let me study everything about this property. This is why it takes a while. Let me study everything about that property and compare it to my property and go, okay, well, our property, sorry, both of ours.
Okay, you can have those 10. I'll take the rest.
So I'm looking at it and I'm like, okay, well, first of all, this property is it's a duplex. I'm going to give the example I'm going to give you as a duplex. This property is a comp, supposedly, is only 1 bedroom, 1 bath on each unit. Ours is a 2 bedroom, 1 bath. That's a significant difference. It's a significantly larger number of people who will rent a 2 bedroom, 1 bath over a 1 bedroom, 1 bath. The other thing was our units are 980 square feet each. In the comp, it was like 720 square feet each. And I was like, oh my, like, why would you use that as a comparable? I know the challenge from the appraiser standpoint is that there's not a ton of duplexes, so they kind of use what they can. But the other thing is it wasn't renovated. We had just spent $50,000 renovating it. It had new everything. So I went through and I showed them all the reasons this comp was not the same as ours. And I did it with the comp number 2 and comp number 3. So I basically picked it apart. Even as much as going into Google Maps and doing the street view, one of the comps was on a main road, like it was a 4-lane road, nowhere to park. It's like, it was horrible. The location was horrible. It was right next to a giant empty lot. Like it was a terrible location. And I'm like, our house, our property, duplex is in the middle of a totally nice residential neighborhood, and you're using a comp that's like across the street from commercial real estate with a vacant lot next to it on a super busy commercial street. Like it was not comparable. So what I realized is that appraisers really are they're doing their job as quick as they can, pulling together and saying, here's what I think, but nobody cares about your deal as much as you do. And nobody knows your deal as well as you do. So I went through, picked apart each of those properties and made like a Word document, showed pictures, especially the one with the street, showed pictures of the street, pictures of our street to compare. Like, these are not comparable. I showed pictures of the insides of the other properties. None of them were renovated. And because the appraiser went in when we had tenants in there already, and the timing was our tenants were just moving in, like they had moved in a few days before, so it was total chaos because they're moving. So I don't think she made the connection that this is renovated. So what I did is this is why I always tell you guys, get professional photography done when you're done with renovations, even for a rental, because it totally served us. So I sent them all the pictures and I said, this renovation was done 1 year ago. 1 year ago, and here's all the pictures. And it was pictures done by a professional photographer, so they look like on point. So I just made the argument that what they said is absolutely not accurate. But I didn't want to leave it to chance for them to come up with their own conclusion of, well, what is accurate? So then I went and I started studying all the comps around, and I used Redfin. I looked at everything that had sold in the past 2 years. I don't usually go that far back. I just wanted to have enough data. And I went and I found properties. I didn't have to go back 2 years, it turned out. I was able to do 12 months. But I was able to find 3 other properties that were close, like bedrooms and bathrooms, age, size of unit, and location type, and renovation level were all similar. And I basically provided each of the 3 of those, provided photos, provided the square footage, the comparison in a chart and in like description and I can't talk, and in photographs, so that they could see in whichever way the person is, whether they're super analytical and they want to see a chart or they're visual and want to see pictures, it was all represented. So it was a lot of work to do that. But at the end of the day, each one of our properties, the value that we ended up getting was way higher than what they had originally done, and it was closer to what we had established. So we were able to do a refinance on that portfolio because we went back and fought the appraisal. So just because it came up yesterday with Regina, and I had basically told her, go into the course and go watch all the videos, because I did these long extensive videos and showed examples of it. I thought that was a good one to talk about. It just comes up so infrequently, but that's what you do basically if you have a situation where you have an appraisal that comes in lower than what you expected.
First question: when you contested the appraisals, did the bank accept full value of your proposed reappraisal price, or did they just adjust it closer to what you proposed?
They actually wouldn't allow, trust me, I wanted to be able to influence on a number. They would not allow us to say, this is what we think it's worth. They had a specific form that we had to fill out. So I was able to provide pictures and description, but we were not allowed to say, we think this should appraise for $200,000. So we didn't have the opportunity to do that. All I could do is provide comparables that were higher than or at the same value that we were expecting ours to be at, and say, these 3 are the most comparable properties, and then let them draw their own conclusion. So that's how it worked. I don't know that it's going to work like that on every single one. This is the first time we actually ever had to do that. So I don't know if it's like that every time, but I would make my argument more with the comps than just trying to say, this is the value. Let them draw that conclusion.
That's good stuff. We don't have any more questions. Can you believe that?
I can't believe that. Yesterday there was like last week there was like 100 questions.
Last week we had 50 questions. This week we have uno. For those of you that didn't make it, we had our multi-family financial analysis masterclass. It is such a mouthful. I mean,
Blah, blah, blah.
Yeah, multi-family financial analysis masterclass. It was pretty cool. We had quite a few people register. I think like 165 people registered. Stacy delivered it really well today, and then also gave out a calculator for free. So check that out if you haven't seen it. We'll be posting it and probably emailing it and getting all the things to you. So don't worry. If you missed it, it's okay. We recorded it. Then Friday, we have a property tour this Friday at 3 p.m. So if you have a deal and want to present it, reach out to me. Or if you have money and are looking for a deal, hit me up. And in events, there's a link to register to come to the property tour. So if you're interested, just come check it out with us.
Awesome. All right.
There are literally no more questions. Oh, wait. Erica says she has one. Erica, hurry up and jam it in there. Erica has a question. Erica was on our multifamily financial analysis class.
She was.
She's not done asking us questions.
Yeah, you had some good questions, Erica.
Totally. Cool. Well, if you get it in there, I don't know. What else you want to talk about while we wait? Oh, I know. I know. You mentioned about the professional photographer.
Oh, yeah.
And how many ways that served us. One other way that served us is during COVID when it first happened.
Yes.
We had vacancy, and we just took those pictures and created like a virtual tour of the property, and we were able to literally show it virtually and had no skips in our occupancy rate. Okay, Erica got her question in. So anyways, what I'm trying to say is the professional photos will serve you in more than one way.
Totally.
Okay, Erica, what are your thoughts on what are safe leverage ratios? In my personal life, I've been on a debt-free journey for a while now, so debt scares me. I love debt.
Yeah, so I understand that, Erica. We operate in our life like we don't like to have debt, but we don't consider real estate debt as debt. It's leverage. So let me separate the two. So part of it is I go on this journey, and I know, Erica, you're going on this journey and you're talking to one of our strategists, and you'll probably be in our mastermind soon. So one of the things that we have to help you separate in your mind is debt when you're using it for consumption and you haven't earned the money to buy whatever the thing is, and so you just go get it because it satisfies that I want to get it right away. And I'm not like saying I'm a saint by any means. I did a lot of that when I was younger, but we do not like debt either. So I understand. So now we do life differently, and when there's something we want, we save up for it and we buy it. We don't put it on a credit card. So I understand like not liking debt. That being said, when it comes to real estate, when you're building for your future, let's say you have $100,000 and there's a $100,000 property. So with that $100,000, you could buy one property, right? And then you're good. That's it. That's all you can do. Or if you're leveraging, I'm going to call it leverage instead of debt, because you need to reframe what the meaning is for you in your mind. These are different things. When you're going to leverage $100,000, let's say you were going to get 5 properties for $100,000 each, and each one you were going to put down 20% or $20,000. That means with the same $100,000, you could buy 5, let's just say duplexes, 5 duplexes. So you could either buy one all cash and have 2 units, or you could use that same $100,000 and leverage it into 5 duplexes, which would be then 10 units. So now let's fast forward 5 years from now. Each one of those properties, as it goes up in value, you could have one property that went up in value, or you could have 5 of them that went up in value, and it took the same amount of money to make that happen. So when you're looking at real estate, your ability to leverage a specific amount of money into multiple properties is what allows you to build wealth. Now, to your question about what do I believe is a safe thing, that really is going to be on a person-by-person basis. I will tell you that when I was new in real estate and I did not know, and I didn't know to ask that question, I would, on the regular, now this is before Jennifer and I were together, because otherwise there's no way she would have let me do this. She's about strategy. I was like, let me buy real estate. I would on the regular refinance at 90% leverage, because that's what you could do back then. This is before 2008, of course, right? So I'm sure you can imagine how great 2008 was for me. Great. But anyway, so I was leveraged at 90%. And what I learned during that 2008, 2009 adjustment of all things financial is that I never wanted to be leveraged that high before. So as we have built our current business and our portfolio and our real estate, we will not leverage beyond 70%. And even when we did our most recent refinance, we were offered 75%. And we were like, well, I mean, we could pull out more cash, but like we didn't really need cash. I mean, it's always nice to have it, but it was like we would get cash, but at the expense of just creeping up there on leverage. And we prefer to have just a bigger equity position. We feel more comfortable with it. So that's really a personal thing, and everyone's a little bit different. But personally, we like to stay at 70% once we refinance. And if that means we're leaving some money in the property, so be it. Or we're not pulling out as much cash, then so be it. But generally speaking, lenders these days will typically go up to 70 to even 75%. So they consider that an acceptable risk from their standpoint. So I guess you could probably consider that safe. We just don't like to go quite that high.
All right, Mike Morrison, would you use the same method for commercial properties in terms of a low appraisal?
Oh, that's interesting. I haven't actually been in that situation. the short answer to that, Mike, is yes. So I always think through, okay, what is it that created the situation where the appraisal came in low? So you always have to look at, well, what's the evidence they're using? So if the evidence they're using is comparable sales, then I'm going, same thing, I'm going to go look at the comps. I'm going to look at our property compared to their property. I'm going to look at, like, what do they use to drive the value? Because in multifamily, beyond 5 units, they do look at comparable sales, but one of the bigger drivers of value is actually the market cap rate compared to the net operating income. So, for example, let's say when you're looking at the appraisal, you find out, well, hold on a second, they calculated net operating income way lower than you did. So then I would go in and I would like look, how am I going to pick this apart? I'd look at that and I would audit it. Okay, well, why did they come up with such a low net operating income when I'm seeing this? Oh, wow, they totally missed laundry income, storage income, and they're including capital expenditures expense in net operating income, and it doesn't belong there at all. It doesn't go there. So if that was the case, then I would go, I've not been in this situation, so I'm just trying to make up scenarios so I can teach you how to think through it. But that's what I would do. I would just look at what's creating the situation where we have this. If it's comps, I'm going to pick apart the comps. If they're using market cap rate and NOI and the NOI is wrong, I'm going to go pick apart their NOI. If their market cap rate, if I believe that's wrong, I'm going to pick that apart. And I would pick that apart by going and finding other properties that I feel better represent our property and our opportunity. And I would go say, hold on a second, they're saying the market cap rate is, 9%. And here are 4 properties that are 7.9. Like, why would you use such a high one? And the 7.9% cap rate is actually going to drive a much higher value. So I'd say sort of, Mike, although I'm guessing it would probably take me 15 hours to do it. Well, it depends on how much information was in there, but there's so much more to look at with that. But the whole thing is, I'd use the same approach, just in that I'm going to look at what's off, and how can I go attack it, and basically show them why they were incorrect, but then also provide them with here's evidence of what you should be using, and here's why. This is what is more comparable than what you did.
Good stuff. All right, what kind of banks would you approach to do a portfolio loan or cash out refi?
Okay, well, those are 2 different things. Sort of. Where did that come from, Debbie? Okay. All right, so the reason I'm asking who it came from, so Debbie, and I know since you're in our mastermind, I know a little bit more about kind of the different things you have going on. A couple things. Portfolio loan, you can literally just Google portfolio lenders, and I can't remember if I already connected you with Corvest. If not, you can message me and I'll connect you with Corvest. But there's hard money lenders that do portfolio loans. Your fastest way to find it is going to be Googling portfolio lenders and then just starting to make some calls. You could also try going to CIX.com, and putting in what you're looking for and let lenders come to you. That would be another thing that you can do. As far as cash out refinance, that's really just going to be any bank, any lender. It depends on how you are as a borrower. If you're like conventional W-2, very lendable, you could just go to a regular bank and you're just going to ask them what kind of cash, before you get too far into the process, what kind of cash out refinance options do you offer, so that you know before you actually put it in an application. But just be willing to basically do some dialing for dollars and find out what do they have available. But you don't need a special lender for a cash out refi. It's a pretty common product. It's just that some lenders do it and some don't, but it's not like an unusual weird thing. Even hard money lenders have 30-year fixed rental programs these days, and they will also do cash out refinances. So I just start calling around. But for the portfolio part, that is a special lender. Also, commercial banks. Commercial banks is another one that's good for portfolio loans. So.
All right, Mike Morrison, do you have a resource that you use to get private money, and what did they have to provide to be on your list?
So private money for us, and the words private money can be a little bit confusing sometimes, because hard money lenders advertise as private money because the term hard money has a little bit of a stigma to it with some people. So now they start saying private money lender. So it's confusing if you don't know the difference. to me, a private money lender is someone you met or know. It's a person. It's not a business. It's not a lender. And really, finding private lenders has come over the years just through developing relationships. For you guys, as you were getting started, one of the best things that you could do is be very active on your Facebook profile about your real estate, even if you're just getting started. And like, I see Cami is watching, or was watching anyway. And what I was telling her and Leroy was, make sure, they were in the middle of a deal. They ended up backing out of it, but they're in the middle of the deal. I'm like, you should be posting literally every day. Like, here's the update. Here's a picture of the duplex, or here's a picture of the inside of it. And hey, found out our inspector had COVID today. Like, all those things, what that does is it starts to create this story on their personal profile of, hey, we invest in real estate. So other people who want to invest in real estate but aren't willing to invest in their knowledge, invest the time it takes to figure out how to do this, they just want it and they have funds, they're going to seek you out. But if they don't know that you're investing in real estate because you're not posting regularly, you're posting about TV shows or dishes or something else. I'm not saying there's anything wrong with doing that, but if you don't make it obvious that you actually invest in real estate, you're missing out on the opportunity for regular people who have money and have heard, ooh, real estate's great. You're missing out on the opportunity for them to be like, so what are you up to? In which case you can say, yeah, we're doing real estate investing, and we have people who work with us, and we have private lenders, if that's something you're interested in, and then just building a relationship. So it really just comes from talking to people, Mike, and spending the time or letting people to get to know you and trust you. And then when you have a deal, putting together a comprehensive investor packet and then providing that to them so that they can see what does a deal look like and what's in it for them and how long are you going to hold it and that kind of thing.
All right, Chris, what are your thoughts on the best state to form an LLC, your home state, and register as foreign entity in each state that you transact business in, or something else? Fully acknowledged to verify with lawyer and CPA, but just curious what your...
Yeah, thank you.
Yeah, our disclaimer is we are not a lawyer, we hire one.
Yeah, right. And we're also not a CPA. Oh, wait.
Yes, she is,
but I don't know anything about taxes, so I know a little bit. I know enough to get in trouble. All right. Okay, Chris, that's a really difficult question to answer, but I'll do the best that I can. Obviously, you have to talk to an attorney it depends on what your whole strategy is. There's tax strategy involved, there's asset protection strategy involved. So where you should host the initial LLC, whether it be your home state or someone else, it depends on somewhere else, it depends on what your goals are. So if your goal was anonymity, you're probably not going to do it in your home state unless your home state happens to be Wyoming, right? So, or Nevada. In Wyoming and Nevada, there are certain time frames for which your LLC, nobody can tell who owns it. So if your goal is anonymity, you'd probably want to start the LLC there. That being said, I think you're asking the question, do you have your LLC in your home state and then just go register it in all your different states? It depends on what you're doing with the LLC. And that's why it's a little bit challenging to answer this question just broadly, because let's say you're doing a couple flips, you're doing a couple rentals, you wouldn't use the same LLC for that because you're going to end up getting screwed on your rentals because they're going to end up getting taxed like flips instead of getting taxed the way you want your rentals to be taxed, which is getting depreciation expense and having long-term capital gains when you sell. So the other part of it is with holding LLCs, you want to keep in mind that you don't want to just stick everything you own necessarily into one LLC unless you have a pretty significant mortgage on it, which helps to shield you from liability. Because what happens is, let's say you have an LLC and you're just putting a whole bunch of properties in it. Let's say you put 10 properties in your LLC. All right, and let's say you own them all free and clear and you have $1.5 million. Let's say you have $1.5 million of property in one LLC and you have no debt on it. Let's say someone comes on one of your properties and they slip and fall on your property and then they sue the owner of that property. If the owner of that property is ABC Holdings, whoever the attorney is going to go research what else does ABC Holdings have. Oh, ABC Holdings also has this property free and clear and nine more properties. Cool. That's what I call a payday. And then there will be a lawsuit, and if they were found to be successful with the lawsuit, then they go and take everything that's owned by the owner of that house. So, but let's say if for instance you have loans in place for $1.2 million, then the way that you look at it is, okay, so I have $1.5 million worth of real estate, and I have a mortgage for $1.2 million over that. Let's say it was a portfolio loan. That means when someone goes to research your one property, they're going to see, holy cow, especially if it's a portfolio loan, they're going to see that on that one property it's only worth $150,000, there's a $1.2 million loan on it. So it's like, whoa, what? But even if they actually did the research to figure out what all the 10 properties were, what they would see is, okay, there's actually only $300,000 of equity, not $1.5 million, because even if someone sues and they are forced you to sell to pay off the lawsuit, the bank is always going to get paid back first. Like no lawyer, no lawsuit can trump a first mortgage. So having a mortgage in place helps protect you from that. So let's say that you were going to buy properties, but you just don't want to have any debt. You want to own them free and clear. You're probably going to want to hold those properties in separate LLCs, because each one is going to be at risk. So if something happened with that one, you're risking whatever the amount of equity is in it. So that's why I'm like, it's a really difficult question to just straight up answer. That being said, personally, the way that we prefer to do it is that we go and open up an LLC in that state. Because for us in California, it doesn't really make a lot of sense for us to start a company here that we then have to go register in other states, because every LLC that you start here, you have to pay a minimum state franchise tax, even if you're running at a loss. So it doesn't really make sense for us to do that. And then plus, we're not only doing a state filing fee where we live, we're also doing a state filing fee in that other location. So it just provides extra stuff. So we just set up our LLCs in the location. So, but we have Anderson Advisors who helps us with like our asset protection stuff. And if you need a referral, then let us know and we can make an introduction. But it's one of those things where it so depends on what you already own, how old you are, what are your goals, what are you trying to protect. So it's a rabbit hole of questions, but lawyers are able to look at that and go, okay, well, if you're trying to get tax savings, we also want asset protection, and you own these things, do this, have this thing here and this thing there, and that's the best way to do it. And then you decide from there if that makes the best sense for you.
Right on. All right, Joseph, how do you manage your finances for tax season in order to get the best tax benefits from owning real estate? Do you use a CPA and or lawyer?
Yeah. So, Joseph, you actually just joined the mastermind, so you probably haven't even heard this yet. But earlier this year, we had our CPA, Tony Hawkins, come on and be a guest speaker in the mastermind. So one, we do use a CPA. I have a background in accounting, but I'm not a tax specialist. And there's a lot of tax strategy that goes into, everything we do is always within the limits of the law. But I also am not going to leave money on the table if there's an actual deduction that we can take. Well, of course we're going to take it, but we don't always know what that's going to be, right? And especially if you don't have any tax background, you really wouldn't. So having a CPA who is knowledgeable about real estate investing specifically is key, in my opinion. The other key is that they are aggressive and not conservative. Because anybody I talk to that has a super conservative CPA who's constantly telling them all the things they can't do, I'm like, wow, you've probably paid so much more than you had to. But someone who's really good, understands tax law, understands how to present information, or how just for you to set your business up to begin with, is going to help you save taxes big time. So we're a big proponent of making that investment in the professionals, because they will save you infinitely more than they will ever cost you. So yes.
All right, Cassandra, can you chat about a few various business structures that people use that you've heard, and maybe some reasons why, realizing that we need to consult our own professional team?
So I'm thinking, Cassandra, you mean like C Corp, S Corp, LLC. Okay. So sometimes, like if you guys ever hear me interview Anderson Advisors, they come on a couple times a year and I'll interview them. Because they're specialists in, they're attorneys and CPAs all under one roof. And they specialize in working with real estate investors. So they know everything about our business. So they will sometimes suggest doing a C corporation, especially if somebody is flipping property and they've invested in their education, because they will use the C corporation as a structure so that the person can deduct their education within the corporation. Whereas with other entities, that might not be possible. So C corporation from that standpoint. Beyond that, I'm not actually sure why else someone would do a C corporation. If you're running at a loss for a while, that's a possibility. Once you start getting into gain town, you're paying a higher tax rate. So I'm not really a big fan of that personally, but it really depends on what your strategy is. An S corporation can be used. LLCs and S corporations, people go back and forth a lot. So I don't feel super convinced one way or another. I'll just kind of tell you my overall thoughts. We use an S corporation for our business activities that are more transactional in nature. And I don't mean fix and flips. I mean more like the business consulting we do, any wholesale stuff that we do, any kind of marketing, stuff where we have income coming in, but it's not related to a property that we are buying and owning. That's why I say we could wholesale within an S corporation. When it comes to buying and holding, we always do LLCs, though I believe land trust is also an option. I just don't know anything about them. But we always do LLCs for anything that we hold. And also when we're not flipping right now, I don't feel super confident about the market holding for a super long time. So we're not flipping right now, but when we are flipping, we've also used an LLC. But we use a separate LLC from the ones we hold rentals in. The reason is when you're flipping property, your company that's flipping property is considered to be a dealer, just like a car dealer. And it's considered, when you do your tax return at the end of the year, when you haven't sold it yet, it's considered inventory. So, and then when you sell it, you're selling it. So it's considered regular income. It's not long-term capital gains, so you're taxed at the highest rate. Of course, strategically, we work on making sure that that company has expenses, related to the projects that we are, getting killed on taxes. But when you're holding property, you want to have depreciation expense, because then the depreciation expense lowers your taxable income, and that even goes on to your regular 1040 tax return and can lower, like if you are still working a W-2 job, it could end up lowering your taxes because it lowers your overall income. If you combine the two of those together and now on your rental property, you're not getting that depreciation expense, you're not getting the benefit of it, and when you sell, you could get taxed as a dealer and not get the long-term capital gains and actually pay like your full regular income tax.
I didn't even know that.
It doesn't come up very often.
Learn something new every day. Look at that. Okay, let's see. I had Michael Fallon. How do I find out if a lender is legitimate?
It would be helpful, Michael, if you give me a little bit more context. I'll try to answer the question, but if you give me a little bit more context, I might be able to answer it better.
While you're waiting for him to give context, Cassandra said, did I catch that you have your rentals in one LLC?
No.
So I wanted to clear that up really quick.
No. So the conversation earlier was about, I would say we always use, not an LLC. I realized I said an LLC. We always use LLCs when we're doing rental property as opposed to an S corporation. I don't mean we have all of our properties in an LLC, because that would mean we're putting everything we own. If someone does a slip and fall on one property, everything is now at risk, and that's not something that we're willing to do. So this is something we do with our attorneys. We have LLCs strategically with certain numbers of properties in them, depending on the number of units or the size, what markets they're in. So everything is strategic, planned with our
look.
Okay, we're back.
back.
I guess we got paused. How many properties in
How do I
LLC?
find out if a lender is legitimate?
Okay, so let me answer the question about how do you find out a lender is legitimate? I'm not sure where the question's coming from exactly, Michael, but I can tell you a couple of ways. I'll tell you some red flags. Oh, a lender on our site has offered a loan for property. Okay, what does the rest of it say?
Oh, sorry.
I can only see a little bit that comes on the phone.
A lender on our site has offered me a loan for property government sanction, I guess.
Okay, so keep in mind, our Facebook community is 5,600 people right now. And so there's everybody that's on there are all individual. So just because you see it on the multifamily real estate investing page, I know you saw it there, but I wouldn't say that means anything. It doesn't mean anything to us. I don't even know. Yeah. I'm not sure who they are. So, but it's just like there's investors, there's lenders, there's realtors, there's all sorts of people that are in our group. So don't put lender and our site like together in your mind to mean anything. So how do you know that they're legitimate? How you would know that someone is not legitimate is a little bit easier to answer. In that case, if you're talking with a lender, well, first of all, check their website, do as much due diligence as you can to just see, do they seem legitimate? Just the fact that you're asking the question makes me kind of like, Usually if you're asking the question, it's because there's something in your subconscious mind that's making you feel a little bit unsure. So, one, in general, trust your gut. Your gut usually knows things. But if a lender ever asks you for money up front, that's a huge red flag. So a couple things. One, I actually did a video on this, a couple weeks ago. If a lender's offering you 100% financing, that's a pretty good red flag right there. Lenders don't offer 100% financing because you'd have no skin in the game. So usually if someone says, we can do up to 100%, BS. No, they can't. No, they can't. No, they won't. No, they don't. So I'm not saying it would never happen. It's just, it's so rare that you could pretty much consider it to be, okay, what you're probably trying to do is get me in the door, lock me up, tie up your time so that you can't go find another lender, and now you have no time. You got to take whatever terms they offer you. So 100% financing, I don't think that's legitimate in general. The other thing is if they're like, oh yeah, just go ahead and put down this deposit, or we need an upfront fee, or we need a down payment. No, absolutely not. Somebody we know just had this happen, and the supposed lender said, oh yeah, we just need you to put a down payment of $2,500 to get $60,000 like gap fund loan. Yep, they've offered 100% and $3,000 up front. And tell us who it is. Yeah, because bye-bye to them. Yeah, 100% and $3,000 up front. That sounds like... Ask me.
No, I don't play.
Yeah, that's 100% BS. They don't do 100%, and any upfront money you pay, you can pretty much just kiss that goodbye. It's gone. There's a company in Utah called Do Hard Money, and one of the things I did for the past 5 years, well, it's been a year now, but for 5 years before that is I would travel all over the country, and I would work and train new real estate investors one-on-one. And so one of the things that I did with them is we would get on the phone and we would call hard money lenders and we would interview them. And one that always came up, they're very good at SEO, they're very good at going out there, was Do Hard Money out of Utah. And the thing that was interesting, because they would advertise 100% financing, hard money. And I'm like, yeah, right. Brand new, you could have no experience, we'll give you 100% financing. I mean, please. If it sounds too good to be true, it is. In that case, that would have been. And they had that same thing, just like Mark said, 3,000, or just like you said, Michael, 3,000 up front. It was something like 2,500 up front. And the way that they would get new investors to put up that money is by saying, oh yeah, 100% financing. We'll give that to you, and then we'll put that $2,500 towards your fees. So there's no real fee. It's it's risk free. But the reality is you'll never find a deal that will meet their supposed criteria to get 100%. So it's just a way, in my opinion, it's just a way for them to take advantage of people who are new and don't know any better. So that's part of the things that we talked about with our mastermind students, and why we tell them anytime you're going through a deal, like, you run everything by your coach, because we've been ripped off. When we were new, when we didn't know any different, we've been through everything, and now we can see things a mile away. Yeah, Michael, application fee $3,000, not legit. A legitimate hard money lender at the most would have a few $100 application fee. Even that is rare, and that is typically, if they have money due up front, it's usually for the appraisal. So $500-$600 maybe. Beyond that, no way. And any other fees, Mark just commented exactly what I was just going to tell you. Any other fees they charge, they charge at closing, so it'll be on the title company statement. So guys, everybody listening, do not ever send money to a lender up front. unless it's for the appraisal, but that's it. Beyond that, just run and just know if they ever say, we can get you 100% financing, I know you want to believe it. I would want to believe it too. But they're just there to hurt you and not help you and sell you BS and dreams and basically take your $3,000 and leave a bad taste in your mouth. So don't do it. They're not legit. And Michael, message us, make sure you tell us who it is, because we need to go find them and make sure they are off our site. That's super predatory, and I do not want people in our Facebook group getting ripped off. Yeah. Anytime you guys see stuff like that, always please give us a heads up so we can check them out. And if we check them out and see like they're full of it, we'll take them off the page. We're not vouching for anybody on the page saying they're good, but if they're bad, we'll for sure get them kicked off and blocked.
For sure. Okay, Mike Hernandez, how many rental properties in an LLC?
So, it's not so much the number of properties in an LLC. It's more the amount of equity. Because what you're looking at is the point of the LLC is to separate the risk, or is to help mitigate risk. So whatever you have under the umbrella of one LLC is at risk. Let's say you have 5 properties, and each one of the properties has $50,000 of equity. Someone trips and falls on one property. The owner of the property is LLC. So what's at risk is the $250,000 of equity that's in that LLC. So it's not so much the number of properties, though I will say if you're buying an apartment building, just one and done, one LLC per apartment building. But when you're talking about smaller units, 2 to 4 units, it really just depends on how much equity there is, because that's what you're trying to protect.
Cool. I think that's it, guys.
That's it.
Did I see any more? I'm combing through. Combing.
Okay, sorry. We got stuck again. Anyway, we'll see you next Wednesday, same time, same place. Bring your questions. We're here to answer any questions you have. And thanks for being a part of our community.
See you next week.
Bye.